50 points higher on the Nifty now.
We have seen a sharp recovery from the lows of the day, so the Nifty is sitting with gains of 40 points as we speak.
Today also we had a gap up, but after that the market saw a big decline and then a recovery as well.
The Nifty ended more or less flattish with a bit of a negative bias. The mid-cap index, though, that was where the money was. That ended high with a gain of close to 0.5% odd.
Hello and welcome to CNBC TV 18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Sensex and Nifty end with marginal losses after a range-bound session. Mid-caps outperform with the index gaining nearly 200 points. Rupee gains marginal strength against the dollar but remains close to the 80 mark. Biocon falls mildly lower after it sells 5% stake in Syngene via a block deal today. Biocon raises a little over 1,200 crore rupees via this block deal. Tire stocks rally. SEAT and Apollo Tyres soared between 3 and 7% to hit 52-week highs. A rise in auto demand and lower raw material prices and sentiment is something which is aiding the moves in the stock. Government and LIC may offer to sell 60% stake in IDBI Bank. Sources say due diligence from RBI is being sought at every stage of the transaction. Bids likely to be invited this month or in October. That's an exclusive. The market gives a big thumbs up to the new listing today. India's dominant airport service aggregator platform Dreamfolk Services lists at 508 rupees, which is a 56% premium to its issue price of 326 rupees a share. The IPO, which was entirely an offer for sale, was subscribed nearly 57 times. And here's the lineup of what we have in store for you today. We bring you market opinion from Manishi Ray Chaudhary of BNP Paribas and Gary Schlossberg of Wells Fargo Investment Institute. In Corporate Voices, we have Ramesh Iyer of M&M Financial Services for you. Well, let's talk about markets now. Nifty and Sensex end the day flat with a slight negative bias, but mid-caps outperformed. Reliance and Metals lent support while FMCG stocks dragged the market lower. Anuj Singhal is here with the day's trading action. Anuj.
Well, it was a consolidation day for the market after the recent gains. It didn't look like that in the morning when the market had a big gap up for the first 15 minutes or so. And after that came a sharp decline, which was bought into, but towards the end, there was again another round of sort of shakeout. So in some sense, it was perhaps, as I said, a day of consolidation, some profit taking led by financials, but the broader market outperformance still continues. In terms of stocks on the index, essentially the stocks or the sectors which have been doing well, banks and consumption, were down. So Kotak, the Bajaj Twins, Nestle, Tata Consumer, Mahindra, ITC, and of course, drag on the index came from names like Infosys and L&T. What did well for the Nifty? Apollo Hospitals was a top gainer, but the real contribution came from names like Bharti Airtel, NTPC, Tata Steel and Reliance. In terms of the broader market, we had some good gains in tire stocks led by Apollo Tyres. Shriram Transport did well. Crompton Consumer was a stock doing well. Ambuja Cement, Balrampur Chini, all F&O stocks, of course, doing quite well. So the sense you get is it's still a market in which bulls are in control, but periodically you may keep having days of some profit taking.
Well, some days of profit-taking, of course, after the stellar run that we've seen for our own markets. In fact, here's some market opinion for you. Manishi Ray Chaudhary of BNP Paribas believes that India has outperformed this year with respect to other Asian emerging markets. He said he continues to maintain an overweight stance on India. Listen in.
If I look at Asian emerging markets, it's really India and ASEAN, which have outperformed significantly this year. In fact, on a dollar-adjusted basis, India is just about negative. It's kind of almost teetering on the edge, one could say. And there are some other, ASEAN markets like Indonesia or Singapore, which have actually given positive returns this year. I think in the short term, the valuations are looking a bit stretched, especially when compared to the rest of Asia. But as I said, market loves growth. Equities are geared, equity investors, they love growth, and wherever they can see earnings growth, wherever they can see earnings estimates being revised upwards, those are the markets that they will flock to. So, over the longer term, we are still not budging from our, overweight stance on India.
In fact, let's get you some more opinion now. Gary Schlossberg, global strategist at Wells Fargo Investment Institute, said high interest rate would create headwinds for the Indian market. He added that a more challenging macro environment is still ahead of us. Take a look.
I think the focus there has been on the domestic economy, which is holding up quite well. India is among one of the stronger emerging markets in that group, and I think it's feeding off some very good news at the moment. It will be tested, I think, going forward. We are expecting central banks in the U.S., the European Central Bank, to become more aggressive, the Federal Reserve maintaining that aggressiveness with 75 basis point hikes beginning this Thursday, we think, with the European Central Bank. So higher interest rates, I think, will create something of a headwind, or at least a test for the Indian market. Difficult to say whether or not the market will test new lows. Quite possible. What we do think, and what we've been thinking all along, is that the more challenging macro environment is still ahead of us. As I said, the Federal Reserve continuing to raise interest rates aggressively for at least one more meeting. And we do look for the U.S. to enter a recession by the end of the year. And of course, that against the global backdrop that is less than promising as well. So here, for sure, we think it will be a more challenging environment. Whether or not it hits those earlier lows, pierces them, remains to be seen.
Okay, then let's move on to the second headline now. Biocon ended mildly lower after the company sold 5% stake in Syngene via a block deal. Biocon holds 70% stake in Syngene. Nimesh Shah is here with all those details. Nimesh?
Well, Syngene was in focus today as promoter entity Biocon sold 5% stake in the company via block deal. The deal was executed around 560 rupees per share. And in terms of buyers, what I understand from sources, a mix of both domestic and global investors, including some long-only funds, did participate in today's block deal. Now, while the street was anticipating a larger block of 10% from Biocon, Biocon has sold only 5% stake as of now in Syngene. More interestingly, now there is a 90-day lockup for Biocon. So further stake sale in Syngene cannot happen from Biocon for the next 3 months. So stock was in focus today, but as things stand, from what I understand, Biocon has indeed sold 5% stake in Syngene to larger investors today.
Okay, Nimesh, thanks a lot for joining us with all those details. That's all about Biocon. But moving on to the third headline today, CEAT and Apollo Tyres soared in trade to hit a 52-week high level on the back of a rise in demand and fall in raw material costs. Generally, fundamentals are looking good. So Sonia Shenoy is here with the details of what's driving this move on these stocks. Sonia.
Well, most tyre stocks have been hitting 52-week highs like CEAT, Apollo Tyres. In fact, JK Tyres is also just 10% away from its 52-week high. Now, what are the reasons for this rally? The most obvious reason, of course, is the pickup that we've seen in auto demand because of the slew of new launches. Morgan Stanley put out a report where they said that the tonnage for tyres will go up by 11% on a compounded basis from FY21 to FY25. Apart from that, there is an improvement in sales of SUVs and commercial vehicles, which are high-margin products, and hence that will result in more tonnage and better operational efficiency for the tyre companies. The second reason is that raw material prices have now become supportive. Both natural rubber as well as crude oil prices have fallen significantly from their peak. Crude oil prices are down 20% from their peak in June, while natural rubber prices are down 17% from their peak in November. And remember, both crude and natural rubber form 90% of the raw material costs for tyre companies. Now, the third reason is that there is a big wave of premiumization in the tyre companies. All the new auto OEMs or the new vehicles are using premium tyres with better safety features and advanced technologies, and companies like Apollo, JK as well as CEAT are specializing in this, or rather focusing on the premium segment. In fact, Apollo in the year 2021 launched Vredestein tyres in India, which is the premium segment, and those tyres are 40% costlier than Apollo tyres. Hence, this focus on premiumization is also aiding the tyre companies. Finally, let's take a look at the valuations for these companies. You have CEAT, Apollo, MRF that are trading at about 20 to 30 times FY23, and MRF is trading a bit expensive at about 24 times FY24. The cheapest of the lot is JK Tyres, which trades at about 9 times FY24 and 16.5 times FY23. Back to you.
Sonia, thank you so much for making sense of what really led to moves on these stocks today. For now, we'll take a short break, but stay tuned. We'll be back in a bit with all the other headlines.